Let's Talk Money.
Welcome back. You're with us on Let's Talk Money. It is the last edition of the show this financial year. So we're ending by talking about the asset class that has been the best performing in FY25. And that is what else but gold. So Lakshmi is still here with us, and we need to understand how best to now take exposure. And now the fun and games aside, now it will be serious because we're talking about, portfolio planning, Lakshmi. So given the rise and given how you're seeing, and you wear that hat which allows you to see markets across equity, fixed income, everything. How much allocation would you advise? And this is, let's take, if we take a 3-year view, someone wants to build their portfolio today.
Yeah.
How much should they give to gold?
So, Surabhi, this conversation I keep having with a lot of investors, whether it's retail or whether it's an institutional investor. And world over, if you try to scan through, there is no real rule of the thumb as to what should be the ideal allocation of gold in your portfolio. But, scanning through markets over 2.5 decades, I think anywhere in the band of 10 to 15% is optimal allocation, which I still believe, therefore, it will be more tail-ended allocation to your portfolio rather than keeping it front-ended.
Yeah.
And I know that investors do tend to get carried away by recency bias, trying to say, equity has done nothing, fixed income is just pure carry or nimbu pani, or not even nimbu pani, sometimes just pani.
Just plain water.
Yeah, plain water. So what do I do? So let's pump all the money into gold. That's not the right way to look at. So I think 10 to 15% of the tail end is absolutely fine.
Okay.
And why I also say that, Surabhi, because the known gold is what we do as part of our financial, portfolio allocation. But so much of unknown gold. I mean, unknown as in we buy jewelry, we have gold coins and all of those physical gold, which probably we may or may not really be having the actual tab of.
Yeah.
So I think with all of that, any which ways, you'll be plus.
So
in any
financially
household.
Limited to maybe about 15%. Now,
That's
for
true.
those who already have that exposure, they're fine, they're happy, they're just enjoying the ride. But for someone, like I said, who's either building a new portfolio or was too, equity dependent, equity only, and realized their mistake looking at this rise, what should they do? How do they approach it? You mentioned gold ETFs. Is that the best port of call?
No, absolutely. So, you have gold ETFs for those who have demat accounts, and for those who do not have, they have gold funds, where essentially they are actually, feeding into these gold ETFs. So, you actually have both these optionalities available for you to own physical gold, but in the demat or the paper form.
Okay.
And I would say that, and it's worked fantastic for me, for example, just kind of do it in a staggered manner, because I'm not going to divest out of gold so long as I have a financial portfolio of equities and bonds or fixed income in the portfolio. I'm not going to divest out of gold.
Sure.
So it's just going to continue. It's my term cover on my financial portfolio.
So just do a SIP in one of these gold funds, you're saying?
Yeah, you do SIP, or you just do like a staggered investment, take a $10 and say that, I'm going to stagger it across 4-5 months, like in a lump sum, and just leave it for like 10, 15, 20 years.
Got it.
As long as you are running your financial portfolio, you do not need to divest out of gold.
Now, apart from the demat difference, obviously, if you want to buy an ETF, you need to have a demat, and then you can buy those units. Apart from that difference, is there any other difference between gold ETFs and funds in terms of structuring, taxation, cost efficiency, anything else?
So, gold funds have a slightly added layer, obviously, because it's a fund of fund investing into the ETF. So, that's the additional small layer. But I would say, Surabhi, you need to compare this with physical gold buying.
Yeah.
With all the tamcham where you have so much of inconvenience in owning the precious metal. Here you have certified gold. These are all LBMA, London Bullion Metal Association approved gold bars, which are the underlying, which are in the, I would say, behind the curtain.
Yeah.
So they are still being held in the form of gold, for a pool of investors.
Sure.
So I'd say the convenience is what you're really buying into. And it's so liquid. I mean, I just get up, decide, to redeem today. The gold ETF allows you to buy intraday from markets open, till markets close. Whereas gold funds, you get the end of the day NAV. That is the only differentiation. And gold ETF, I can decide to sell. Similarly, the way I decide to buy, I can sell and buy on the exchange. So if you want the comfort of, punching in trades from the comfort of your house, on the exchange, it's gold ETF. You pay that marginal cost extra, but you don't have a demat account, you're still better off owning the gold fund.
And remind us of taxation as well, because when the whole long-term capital gains tax regime was kind of rejiged last year, the fund of fund structure also kind of, there was a categorization difference. So today, when I'm finally redeeming my either gold ETF units or I'm selling off my gold fund, what is the capital gains tax I'll have to pay?
So short term is as per your tax
slab rate.
And then long term is the 20% taxation.
Okay, so 20% long term, short term would be?
Yeah.
And the definition is 2 years.
For long term?
Yeah.
That's right, yeah.
Okay, so that kind of explains the tax part of it. Now, very quickly, this is the mutual fund route through which I can play gold in a very, very safe manner. And what I get back, we must remember that you don't get physical gold back. You will get back your investment in monetary terms. There is this whole sort of move around digital gold as well. And there are a lot of fintech players. And many of them offer, buying gold in a digital format, very small token sizes, 100 rupees, 200 rupees. And they promise to give back physical gold when you redeem. I don't know if you've seen some of these apps or these players or not.
Yeah,
and whether you find them, I don't know, are they safe enough?
See, I have not personally experienced something like that. Of course, I do track a lot of these things. So here's the thing, from a retail investor standpoint, if it is a regulated entity, which is, regulated by either the central banker, more so in this case, it'll be, since it's capital markets, more like SEBI. If it's a regulated entity, then I would say it's still worth taking a chance. But, if it is something which is more haphazard or loosely held, or, you don't really have a backing of an institution, I would say you're better off doing something which is more time-tested, which has been in existence for now decades. And, why kind of reinvent the wheel? I'd also say that if you're wanting to do 1 kilo bars and multiples of a kilo, you can actually get physical delivery in the gold ETF as well.
Oh, so gold ETF will give you physical delivery, but for larger quantities.
1 kilo is the bar size, so that's the minimum lot, and multiples of a kilo is what you can expect.
1 kilo of gold, when can I afford that? I don't know. Let's see, we'll find out. So, Lakshmi, final thoughts, we're wrapping up, and, since you're the master of so many markets, have to ask you this. The financial year is ending, we're looking forward to FY26. What's your advice? And in terms of the market, if I were to ask you to, be a prophet and talk about what asset class might really surprise us on the upside next year, which one?
Oh, that's the most tricky question.
I know, it's an unfair question, I admit.
But I'd say, the way I'd put it, Surabhi, is that you require, and Prayagraj is just behind us, so we did all the, I also did go to the Triveni Sangam for the holy dip. So these markets are going to be, constant dips, and whatever dips has to come up. You can't be forever sunk into the water, so you have to come up. Similar is our portfolio. So you need to have the right combination of Brahma, Vishnu, Mahesh. If you are the creator of your wealth and you want to sustain this wealth, then you have to have the right proportions. And I say, when I say Brahma, Vishnu, Mahesh, Mahesh is more like a disruptor, which is like an equity, which kind of keeps, giving you volatile jing bangs in your portfolio. But you have to stay the course. Lage raho is what I would say. And FY 2026 or this year is going to be full of latkas and jhatkas, and it is going to test your nerves. And that is the time, Vishnu comes in handy. Vishnu is the protector. And that's where I said gold will be that Vishnu. It's kind of, Vishnu ji is always like this, and, a hand like this. And that is the role that gold plays in your financial portfolio. But you have to, stay the course. If your doctor gives you a medicine which says it's a 5-day course, and if you disrupt it and say, okay, 3 days and I'm done, it's going to come back. So keep that in mind, when you are engineering or when you're creating your financial portfolio, because this is not something which is going to last you financial year after financial year. It is for a longer time. And that is the reason have a lot of vitamin P, which is the patience pill. This market is going to test your nerves, test your patience, and don't please get carried away by the recency bias.
Fantastic, fantastic. And it's a great pious, spiritual, philosophical note to kind of end on, right? As we are bidding goodbye to FY25 and welcoming the new year. So may this new upcoming year be the perfect sangam for you as well in terms of your investments and your wealth creation journey. Lakshmi, thanks very much. Always a fantastic conversation. Thank you so much for joining us on the show today.
Awesome. Thank you.
With that, it's a wrap on this edition of Let's Talk Money. We will see you again next week in a brand new financial year with more thoughts, more ideas on wealth creation.
Let's Talk Money